Good afternoon. This is Tom Alexander. It's Wednesday, May 11th. It is about 4:55 p.m. Eastern time. I'm out of my office. I'm on a laptop, but today we're having some drama, so I wanted to cover some things. So be patient with me because again, I'm on my laptop, so this could be a little bit unwieldy. Let me show my screen. All right, let's see. Okay, what you're seeing here, this is the S&P. Now, included in this report, I have included a link to a video to a bid I did with Ben Lichtenstein of TD Ameritrade this past Monday morning. And I talked about this very thing that is going on now, the proverbial falling knife. I have been talking and preaching and reminding and exhorting for weeks now the importance of levels and honoring levels. And initially it was at 4,300 level. We broke below it, above it, below it, and now we're in some sort of waterfall decline that I thought might happen. Now, where are we in this waterfall decline? I don't really know. We'll talk about that in just a minute. What you see on the screen here, this is a weekly chart of the S&P cash. So where does this thing stop? Where is quote unquote support? Well, I don't use magic numbers. I don't use fib stuff, projections, all this other stuff. I use simple auction market concepts. Now, the move off of the 2020 low was so extraordinarily vertical. There's just not a lot on the horizontal scale that you can hang your hat on. We're in maybe an area here, and it's a rather broad area, somewhere from where we closed tonight down to 3,700. Now, I know that's not a whole lot of help, but it's just the reality. It's the reality of how vertical this move was to the upside. So what are we looking for now? What can we use? What can we logically deduce from what's going on now? And I'm going to go through each of the indices, so bear with me. What is going on now from this high back on, what is this? March 28th, not that long ago. This is a distribution range. This is an auction range, and this is vertical development. So we can basically break down what is happening now and focus on this. So is this market just going to crash a la 2000 all the way down to who knows where? It could. It certainly did in 2000. But even if you go back in 2020, that's what I'm trying to say here when I say 2000. If you go back into 2020, you go to a daily, down to a daily time frame, this is weekly, it got to a point where you would have these ripping rallies and you'd have lower lows and ripping rallies. Well, today was another piece of evidence that we're in some phase of a washout to the downside. Now, I don't expect the market to continue lower at the present rate of change, even on a daily basis. Let's go to a daily basis. So here you go. So we can sort of break down. Now, when you go more granular, you can see the pockets of retracement and balance. But the retracements have been extraordinarily so far shallow, from the tick low here to the tick high on the, what was this? The 4th. You know, that was about a 6% rally, and it immediately failed. Well, back in 2020, we had several rallies, 10+%. We certainly don't have that now. So this is a distribution. If you look on the weekly chart, this is a distribution range to the downside, an auction range. And within this auction range, there's another distribution that began at the May 4th high. I'm going to go over here down to here. So in the last, what is this? 1, 2, 3, 4, 5 days, we're down 8.76%. We're not going to continue. We may go a whole lot lower, but we're not going to continue lower at this rate of change. So what we're really looking for here, we're looking for some form of balance to occur. We're looking for balance to occur in this distribution range, the larger degree, and we're looking for balance to occur in the shorter degree auction. This is the distribution range. You're going to get, sooner rather than later, you're going to get a more two-sided trade. You're going to get something like this. Something like this, something like this, something like this. Even if we go a whole lot lower, you're going to begin at some point, because we're getting so extraordinarily compressed to the downside, that just normal rotation, normal auction market mechanisms, you're going to get a ripping rally. I don't know when it's going to occur, and neither does anyone else. This is really, you know, if you are a swing trader, you have to sit back and be patient here and let the market take out a previous day's high or 2-day back high, etc. And those going forward are going to be the upper key reference area, regardless of the time frame you trade. For instance, tomorrow on Thursday, the important key reference area is going to be today's session high. To the downside, it's a guess. To the downside, what you're dealing with now is a rough estimate of what the current ranges are. So for instance, okay, the day's range was from here to here. Now, if tomorrow opens, depending on where it opens, obviously, but if we have just a similar range tomorrow to the downside, then you're looking at 38.14. And that's as good an estimate, and this is as sound a calculation as anything that's out there. It's not magic, it's back of the envelope type of stuff, but it gives you an idea for what might be an extreme. Now, let's look at the NDX. And let's go to weekly. And the NDX is just, is something to behold at the moment. But again, looking at it objectively, it's not going to continue lower at this rate of change. We're down off of the March 28th high. How much are we down? We're down 22%. And you're already into a broad area of previous auction market activity that was two-sided prior to a ramp higher. If we go down in time frame, similar picture, obviously, as the SPX. You know, we're in a distribution range within the larger distribution range that began on May 4th. Where does it stop? I don't know. I can tell you, though, that this cluster of highs here that includes today's cash session high is going to be important. Back to the upside. This has to be closed above before you can make any sort of assumption about balance forming, a low possibly being in place, etc. Now let's look at the Russell. And the Russell obviously is in a similar position. I mean, it's been the weakest, and it is, from a structural perspective, the Russell is in the same position as is the ES and the NDX, or the S&P, NDX, ES, NQ, you get it. Okay, let's look at the Dow. Now, the Dow has been holding up relatively well. And let's crunch it up. And there is a cluster here of volume on the horizontal scale that we're rapidly approaching right in here. Okay, now let's look at the profile view. and see if it adds anything to the picture. And I'm just going to take the S&P, the S&P cash. And what we have here, this is the May auction. And the May auction is not particularly well developed. It's a trending looking profile so far. And that also tells me that sooner rather than later, and it may not be until June, you're going to, this will eventually truncate into something like we saw at the end of April. You know, I posted a chart, gosh, a week or so ago in the weekly reports talking about, sometimes it's elegantly simple, analyzing auction market condition using the profile chart, and you don't have to use all this secret language and all the cool semantics that people want to brand themselves with that use market profile. The bottom line here is that this is a an increasingly wide range auction, and we don't even know if the distribution is complete yet. That's the takeaway from this. There's nothing else from a market profile perspective to be that can be added to this. There's no magic. Again, high volume nodes, naked pointed controls, all this other stuff is nonsensical, doesn't apply now. All you need to know is this is what I would consider to be an incomplete auction. It's a very vertical auction. There's not a whole lot of overlap, but that fits with what we're seeing on the bar charts as well. Okay, let's take a look at the technical situation. And I use a very simple technical tool. I use NYSE advancing minus declining issues. This is a 10-day moving average, excuse me, of advancing issues. The green is a 5-day. And of course, this is breadth, just NYSE advancing minus declining issues. Now, something I'll point out, at today's close, there's an extremely significant divergence between this lower low and breadth. Now, lows are highly correlated with this type of setup. However, there are a lot of false positives, and it's a correlation. It's not a causation for a rally. What it would take for me to give this any credence is if tomorrow we begin ripping higher, we're starting to make higher highs and higher lows in the intraday timeframes, then maybe this is playing out. Right now, I would just make note of this. But the other thing I'd make note of is the 10 days rolling over. The 10-day moving average reached an extreme back in January that had not been seen since March of 2020. And here we are lower. Now, yeah, there's a divergence between here and there, but that's to me of dubious value at this point in time. And ultimately, you can simplify your analysis and you can simplify your trading by just following the actual auction, following the price, following the bar charts, understanding how to use and when to use the market profile graph. Right now, bar chart is your friend in terms of analyzing what's going on with this auction. We're heading lower as of this close. Now, if we were to close above today's session high by all 4 of the primary U.S. trading indices, that would be a positive. That would be something that might be signaling at least very little further price damage and either a balance area forming or this ripping rally, because at some point we're going to have a ripping rally. And that's pretty much it in a nutshell, guys. I hope you found this helpful, and I will continue to update this situation as it develops.